One evening, while scrolling through YouTube or X, you see a headline. This guy turned $5,000 into $500,000 with crypto. Another creator claims Bitcoin is going to $1 million. Someone else says banks are dying, governments are printing money into oblivion, and cryptocurrency is your only chance to escape. Within minutes, your entire financial strategy starts to feel slow, almost stupid. Why spend 30 years investing patiently if other people seem to become rich in just a few months? That's exactly how millions of ordinary people entered the crypto market. Not because they spent hundreds of hours studying blockchain, not because they deeply understood monetary policy, but because they felt like they were missing the greatest opportunity of their lifetime. And that's what makes cryptocurrency so dangerous for the average investor. Not the technology, not even the volatility, the psychology. Because the biggest risk in crypto isn't Bitcoin. It's human nature. Today, I want to explain why cryptocurrency has become one of the most misunderstood investments in modern history. Not because it can't make money, it absolutely can, but because the way most people approach it almost guarantees disappointment. Here's an idea that explains almost everything about speculative investing. People don't buy assets because they're valuable. They buy assets because someone else already got rich. Think about the last time someone recommended crypto to you. Did they explain how blockchain improves settlement efficiency? Did they discuss decentralized consensus mechanisms? Did they compare different monetary systems? Probably not. Instead, they talked about returns. They talked about someone buying Bitcoin at $500, someone becoming a millionaire, someone retiring before 30. Someone buying a Lamborghini. The investment came second. The story came first. And stories are incredibly powerful because they don't appeal to logic. They appeal to imagination. They allow you to picture a different version of yourself. Debt-free, financially independent, no boss, no stress, no alarm clock, no worries about retirement. For just a moment, crypto doesn't feel like an investment. It feels like an escape. Behavioral economists have a name for this: FOMO, the fear of missing out. It's one of the strongest psychological forces affecting financial decisions. Because humans aren't wired to evaluate investments objectively. We're wired to copy successful people. Thousands of years ago, that instinct kept us alive. If everyone ran away from danger, you ran too. Today, that same instinct tells us that if millions of people are buying an asset, it must be a good investment. But markets don't reward following crowds. In fact, they often punish it. Every financial bubble in history has followed a surprisingly similar pattern. Prices begin rising. Early investors make extraordinary profits. Media attention explodes. Stories spread faster than facts. People who had never shown interest in finance suddenly become experts. Taxi drivers start giving investment advice. Family dinners become discussions about price predictions. Everyone starts believing this time is different. We've seen this before. The dot-com bubble, housing, tulips, railroads, and yes, crypto. That doesn't mean every innovation fails. The internet survived the dot-com crash. Railroads changed the world.
Blockchain may continue finding meaningful uses, but history teaches something incredibly important. A revolutionary technology can still become a terrible investment if people overpay for the dream. That's a distinction many investors forget. Technology and investment returns are not the same thing.
Now here's something that surprises many people. Volatility isn't actually crypto's biggest problem. Volatility simply reveals something deeper. The real problem is uncertainty.
Imagine buying shares in a company like Apple. You know what Apple sells. You understand where revenue comes from. You can estimate profits. You can evaluate competition. You may disagree about valuation, but at least there's something tangible underneath.
Now ask yourself a much harder question. How do you determine what most cryptocurrencies are actually worth? Not what someone else is willing to pay today, what they're fundamentally worth. For thousands of crypto projects, that's almost impossible to answer. Many generate little or no cash flow. Many solve problems that few people actually have. Many exist simply because someone created another token. Some disappear within months. Others survive only because new investors continue buying. That's not investing. That's speculation. And speculation isn't automatically bad. Professional traders speculate all the time. The difference is that professionals usually understand they're gambling on probabilities. Ordinary investors often believe they're investing with certainty. That's a dangerous misunderstanding. Another reason crypto attracts so many people is something psychologists call variable rewards. It's the same mechanism used by casinos. Imagine pulling a slot machine. Most of the time, nothing happens. But occasionally, you win. Your brain releases dopamine. You feel excitement. You want to try again. Financial markets can trigger the exact same response. Most investments grow slowly. Index funds aren't exciting. Bonds aren't exciting. Diversification isn't exciting. But watching a coin rise 40% overnight, that's unforgettable. Even if it falls 60% next month. Your brain remembers the excitement far more vividly than the loss. This creates an addictive feedback loop. You stop thinking like an investor. You start thinking like a gambler, chasing the next big win. And that's exactly why so many people constantly jump from one trending coin to another. Not because they have a strategy, because they're chasing a feeling. And feelings rarely produce good financial decisions. One of the biggest myths surrounding cryptocurrency is that ordinary investors are early. You've probably heard this countless times. We're still early. But think carefully about what that statement actually means. Bitcoin was created in 2009. Major financial institutions now offer Bitcoin ETFs. Governments regulate crypto markets. Public companies hold Bitcoin on their balance sheets. Millions of people around the world already own digital assets. That doesn't necessarily mean crypto has reached its ceiling, but it does mean something important. You're no longer competing against hobbyists mining coins from their laptops. You're competing against hedge funds, algorithmic trading firms, institutional investors, market makers, professional traders with faster data, better tools, and significantly more experience. The game has changed, and yet many new investors still enter believing they've discovered a secret that Wall Street somehow missed. History suggests that's rarely how markets work. Here's something that almost nobody talks about. The biggest loss in crypto
isn't always the money you lose. Sometimes, it's the money you never earn somewhere else. Economists call this opportunity cost.
Imagine two people start investing at age 25. Both have exactly the same income. Both invest $500 every month for the next 10 years. The first person consistently buys a diversified index fund. They don't check prices every day. They don't try to predict the next recession. They simply automate their investments and move on with their lives.
The second person is convinced crypto is the future. Instead of buying productive assets, they constantly move their money between Bitcoin, Ethereum, meme coins, AI tokens, gaming tokens, DeFi projects, and whatever happens to be trending that month. Sometimes they double their money. Other times they lose half of it. They experience incredible highs, painful crashes, constant uncertainty. 10 years later, who has more wealth? Ironically, history suggests it's often the first investor. Not because they found extraordinary returns, but because they avoided extraordinary mistakes. Charlie Munger once said that the first rule of compounding is to never interrupt it unnecessarily. That's exactly what speculation does. It interrupts compounding. Every emotional decision, every panic sale, every attempt to chase the next opportunity resets the process. Successful investing isn't usually about finding the fastest growing asset. It's about staying invested long enough for compounding to do the heavy lifting. Crypto often convinces people to abandon that process entirely. Another uncomfortable truth is that crypto rewards visibility more than understanding. Think about who dominates the conversation online. Not blockchain engineers, not computer scientists, not cryptographers. Influencers, content creators, anonymous accounts posting screenshots of massive gains, people standing next to rented sports cars, people promising financial freedom through a coin you've never heard of. Their business isn't necessarily investing. Their business is attention. And attention has its own economy. Every shocking prediction generates clicks. Every bold price target creates engagement. Every dramatic thumbnail attracts viewers. Bitcoin to $500,000. This altcoin will make you rich. The last chance before the next bull run. These headlines spread because certainty is attractive. Reality is not. The truth is almost always more boring. Nobody knows where prices will be next year. Nobody consistently predicts market cycles. Nobody has a crystal ball. But uncertainty doesn't sell. Confidence does. As a result, many people confuse confidence with expertise. They're not the same thing. Some of the loudest voices in finance have no special ability to predict markets. They simply know how to capture attention. Then, there's another risk that rarely exists in traditional investing. Counterparty risk. When you own shares through a regulated brokerage, multiple layers of oversight exist. There are regulations, audits, reporting requirements, investor protections. It's not a perfect system, but it's designed to reduce certain risks. Crypto often asks individuals to become their own bank. At first, that sounds empowering, until you realize what it actually means. If you lose your private keys, your money may be gone forever. If you send funds to the wrong wallet, there's usually no customer support, no fraud department, No password reset. No undo button. People have accidentally thrown away hard drives containing millions of dollars worth of Bitcoin. Others have transferred funds to incorrect addresses. Some have trusted exchanges that later collapsed. The technology removes intermediaries, but it also removes many safety nets. Freedom and responsibility increase together. Unfortunately, many new investors only appreciate that responsibility after something goes wrong. The collapse of several major crypto companies also revealed another important lesson. Sometimes the greatest risk isn't cryptocurrency itself, it's the businesses built around it. People often assume that if an exchange looks professional, advertises during major sporting events, or has celebrity endorsements, it must be trustworthy. History suggests otherwise. Several well-known crypto companies appeared successful until they weren't. When confidence disappeared, billions of dollars evaporated almost overnight. Customers discovered that trusting a platform isn't the same as owning an asset. Again, this isn't unique to crypto. Fraud exists everywhere. But crypto markets have historically attracted higher levels of speculation, weaker oversight in many jurisdictions, and a faster pace of innovation than regulation can keep up with. That combination creates fertile ground for mistakes, scams, and excessive risk-taking. Now, let's address the argument you'll hear most often. But what if Bitcoin becomes the future of money? That's possible. No one can rule it out. Technology evolves. Financial systems evolve. Innovation matters. But here's the mistake many people make. Even if Bitcoin succeeds, that doesn't automatically mean every investor succeeds. Think back to the internet. The internet changed everything. Yet thousands of internet companies disappeared. Owning random .com stocks in 1999 wasn't the same as benefiting from the internet revolution. The same logic applies today. A technology can transform the world, while many investors still lose money chasing the hype surrounding it. Investing requires more than identifying a trend. It requires buying at a reasonable price, managing risk, controlling emotions, remaining patient. Those skills matter regardless of the asset. Perhaps the greatest danger of crypto isn't financial, it's psychological. Markets have a remarkable ability to consume attention. People begin checking prices every hour, then every 30 minutes, then every 10. Their mood becomes tied to charts. A green candle improves their day. A red candle ruins it. Instead of focusing on increasing their income, learning valuable skills, building a business, improving their career, they're watching numbers move on a screen. Hours become weeks. Weeks become years. And one day, they realize something surprising. They spent more time thinking about money than actually creating it. That's an expensive distraction, because wealth is usually created through productivity first, investing second, not the other way around. Here's another question worth asking. Why are people so eager to believe extraordinary financial stories? Because ordinary wealth feels boring. Nobody wants to hear that becoming financially independent often involves decades of disciplined saving, living below your means, buying productive assets, ignoring market noise, repeating simple habits year after year. There's no viral headline in that. There's no glamorous thumbnail, no overnight success story. But boring strategies have one incredible advantage. They've worked for generations. Markets change. Technologies change. Currencies change. Human psychology doesn't. Fear, greed, patience, discipline. Those forces continue shaping every financial decision we make. And investors who understand psychology usually outperform those who simply chase excitement. So, does all of this mean you should never buy cryptocurrency? Not necessarily. That would be just as simplistic as saying everyone should buy it. The real question isn't whether crypto is good or bad. The real question is whether it fits your financial life. For someone with high risk tolerance, a diversified portfolio, stable income, and a clear understanding that crypto is speculative, allocating a small percentage of their investments to digital assets may be perfectly reasonable. But that's very different from making crypto your entire financial plan. Unfortunately, that's exactly what many people do. They don't build wealth first. They chase wealth first. And those are completely different strategies. Imagine trying to build a house. Most people begin with a solid foundation, then the walls, then the roof. Crypto encourages people to start with the rooftop. It promises that one lucky investment can replace years of consistent financial habits. Sometimes it works. Most of the time, it doesn't. Because lasting wealth rarely comes from extraordinary returns. It usually comes from extraordinary consistency. One of the biggest misconceptions about investing is that successful investors spend their lives finding the next big opportunity. In reality, many of the world's most successful investors spend more time avoiding bad decisions than chasing exciting ones. Warren Buffett has often explained that investing isn't about swinging at every pitch. It's about waiting patiently for the right one. That mindset feels almost incompatible with today's financial culture. Every day, there's a new coin, a new token, a new prediction, a new influencer promising life-changing gains. The market constantly whispers the same message. Act now. Don't miss out. Everyone else is getting rich. But wealth doesn't usually reward urgency. It rewards patience. That's one of the hardest lessons in personal finance. The greatest investment advantage isn't intelligence. It isn't access to secret information. It isn't predicting the future. It's emotional stability. The ability to stay calm while everyone else is becoming emotional. To continue investing during bear markets, to ignore bubbles, to avoid panic, to resist greed. Those qualities don't generate exciting YouTube thumbnails, but they quietly create financial independence. There's another reason crypto feels so compelling. It offers certainty in an uncertain world. Think about how often we hear statements like, "Fiat money is doomed. Bitcoin will replace banks." This is the future. The future is always presented as if it's already been decided. But history rarely works that way. Technological revolutions are messy. Unexpected winners emerge. Early leaders disappear. Entire industries transform in ways nobody predicts. The automobile changed transportation, yet hundreds of early car manufacturers vanished. The internet transformed communication, yet countless internet companies failed. Innovation doesn't eliminate uncertainty. it creates new uncertainty. Crypto is no different. Could digital assets continue growing? Absolutely. Could blockchain technology become more integrated into global finance? Very possible. Could Bitcoin remain an important asset for decades? Certainly. But none of those possibilities guarantee attractive investment returns from today's prices. That's a distinction investors often overlook. A great technology isn't automatically a great investment. Price matters. Valuation matters. Risk matters. Human behavior matters. Perhaps the most valuable lesson crypto teaches has nothing to do with cryptocurrency itself. It teaches us how easily emotions influence financial decisions. When prices rise, confidence rises. When prices fall, confidence disappears. The asset hasn't necessarily changed. Only the story surrounding it has. That's true in nearly every market. Stocks, housing, gold, collectibles. Crypto simply magnifies these emotional cycles because its price swings are so dramatic. The challenge isn't learning to predict those swings. It's learning not to be controlled by them. The most successful long-term investors understand something surprisingly simple. Every investment carries risk. No investment guarantees wealth. Diversification exists because nobody knows the future with certainty. The moment someone tells you they know exactly where any asset will be in 5 years, be careful. Confidence is cheap. Humility is rare. So before buying any investment, ask yourself a few questions. Am I investing because I understand what I'm buying, or because I'm afraid of missing out? Would I still own this asset if social media disappeared tomorrow? If the price dropped by 50% next month, would I understand why I bought it in the first place? Am I building wealth or chasing excitement? Those questions matter far more than any price prediction, because successful investing isn't measured by your best year. It's measured by the decisions you consistently make over decades. Here's something that often surprises people. The goal of investing isn't to become rich as quickly as possible. The goal is to become financially secure with the highest probability of success. Those are not the same objective. Trying to maximize returns often means maximizing risk. Trying to maximize the probability of success usually means accepting slower, steadier growth. That trade-off isn't exciting, but it works. Think about every millionaire you've probably never heard of. The school principal who consistently invested for 30 years. The engineer who quietly contributed to an index fund every month. The small business owner who reinvested profits year after year. None of their stories go viral. None of them attract millions of views. Yet collectively, they represent one of the most reliable paths to wealth ever discovered. Not because they found a shortcut, because they accepted there wasn't one. Crypto has given the world remarkable innovations. It has challenged traditional finance. It has introduced millions of people to investing for the first time. Those are meaningful contributions. But innovation should never replace discipline. Curiosity should never replace risk management. And hope should never replace a plan. The greatest financial decisions are usually the ones that feel almost boring while you're making them. Saving consistently, avoiding unnecessary debt,
increasing your income, owning productive assets, ignoring daily market noise, repeating those habits year after year.
That's not the story most people want to hear, but history suggests it's the one most likely to work. Because in the end, building wealth isn't about finding the perfect investment. It's about becoming the kind of person who can consistently make good financial decisions. And that's something no cryptocurrency can ever do for you. If this video changed the way you think about investing, consider subscribing. Every week, we explore the psychology behind money, the hidden forces shaping the economy, and the timeless principles that help ordinary people build lasting wealth. Because the best investment you'll ever make isn't the one with the highest return. It's the one that helps you sleep well at night.